Hello, Joe Novickus here. I'm going to look at the put side of a option contract and of the option chain. So here we're looking at Facebook, just like we did on the call side. So the same terminology we're going to use from before. We have the expirations are in parentheses here. This is when the contract expires. And once again, we want to go a little further out. So we're going to go to the 32-day expiration. Actually, we'll go to the monthly expiration of January 2015. And so when we go out and we look at the on the put side means that we have the right to sell our stock to someone at a predetermined price. So this is a trade that we make if we think the stock is going down. So right now we're going to use that same 74. What is it trading at? 76.50. So right now Facebook is trading at 76.50, and we'll go to the 32, the weekly expiration. So closest at the money is one of these two. So what we think, let's just focus on the 76. If we think that Facebook is gonna basically go down in price, we're gonna want to buy the put contract. So the put contract, as a buyer, we get to force someone to buy it from us at this price, at this $76 strike. So if the stock starts plummeting, the put contract will go up in value because it will be worth more. So right now you can see there's not a lot of volume right now on Facebook puts. So probably we wouldn't want to trade this. But if I go a little bit closer, you could probably take a guess on what is going to happen with these put contracts. And you can see there's heavy volume. And you could see, just like on the call side that we talked about in our last video, these contracts are much cheaper. The implied volatility of the contract is basically the time, just like we have on the call side, and the expected downward move, expectation downward move of the stock. Is there downward volatility present? And you can see Facebook is pretty much kind of at a level where it's pretty close to, no one really favoring the call side, no one really favoring the put side. So what we have here is someone's bidding 110 for the 76 put, and someone's looking to buy it, and someone's looking to sell it for 122. So there's your bid ask spread. That's a 2-cent difference. That's what we're looking to. We're looking for those tighter bid ask spreads, and obviously we have a lot of volume here. So if Facebook starts to drop, this contract will go up in value, because if I go to higher strike, let's say 80, you can see the 80 strike. It's trading at, it's in the money right now. It's trading at 370 right now, and you can see as we go to a lower strike, we could see that the premium is a lot lower. So the reason what prices this in is, what is the probability? What is the probability of this occurring? And so as the probability comes lower, so does the premium that you pay. All right, so the people right now that are maybe selling this for $73.50, they're more likely they're going to collect this premium, and the stock will be trading above this, and at expiration this premium will go to zero, and they get to keep that premium. However, if the stock drops to, let's say, $70 a share at expiration, this contract will be worth $3.50. The strike minus the price of the stock at expiration. So people are taking a little risk there. Now, usually when people sell premium, a lot of times they'll go down and they'll buy a lower strike put here just to protect themselves for any downward move. So just like on the call side, we're expecting the underlying stock to go up. On the put side, we're expecting the stock to go down. So that's kind of how we explain a call and a put. And obviously, we have to spend probably about a week or two practicing trading calls. And then we spend about a week or two practicing trading puts. And then once we kind of get a feel of calls and puts, then we can move into a lot of fun and more exciting trades using options. But this is where it all starts. It starts with understanding how to understand the call side, the premium that's in both of the contracts, how puts work, and basically, though, everything derives its value from the underlying stock price. And so we have to work off our levels. We have to work off our support and resistance levels of those stocks to determine which options we want to trade in. So there you have it on the put side. And the next lessons we'll get in a lot more detail and into a lot more of those fun trades.